Tata Steel held their 2021 Investor Day and spoke about their outlook on steel prices, what the roadmap will be for Tata Steel over the next decade, financially and strategically, and interestingly also shed some light on their ESG initiatives, which is going to be a big part of Tata Steel going forward. So first up, on steel, well, they expect this decade, 2021 to 2030, to be better than the last, which was impacted by the China slowdown. This decade, according to them, will actually be led not by China, but by government-led spending, which will also, by the way, spur exports from India as well. There will be global discipline and improved consumption of steel, according to them, in the next decade, and hence they are very positive on steel. On their own operations, they have a target of doubling capacity to 40 million tons by 2030. Remember that Kalinganagar has restarted. They have announced plans on setting up an EAF plant as well, which they believe will be completed by 2025. But more importantly, the mix as well is expected to change. So long products would account for 25% of the India capacity versus 20% currently, and India's share in their overall portfolio would rise to 73% versus 57%. So the rich product mix should continue to benefit. Remember, auto, which is a high margin product, is 21% of Tata Steel's domestic sales. Moving on, talking about then more on operations, iron ore integration in India and recycling in focus. Remember, I told you ESG is going to be a big part. So Tata Steel said that they will continue bidding for iron ore mines, but they are also looking at strategically reducing dependence on iron ore by focusing on recycling. This new AF capacity announced will depend on scrap. So that's very interesting. They're also looking at portfolio simplification. We already know they've created these clusters for India, longs, downstream mining, utilities and infrastructure. But there's further simplification expected in the UK business, in the EU business rather, where they're going to split up the UK and Netherlands business, which according to them will also reduce fixed costs. But back to ESG, they will be focusing on reducing their carbon footprint further. They say Ijmuddin is anyway best in its class. Jamshedpur is a benchmark in India, but they are going to look at more raw material efficiency, recycling, increasing the EBITDA of the byproducts business. Now let's talk about financials. Their net debt to EBITDA target is 2x, which is the cycle average. The FY21 net debt to EBITDA was 2.4x, and management says that the debt reduction plan continues to remain intact, and then of course perhaps rise a little bit with capex. This ratio could fluctuate in case of any acquisitions, but the aim is to maintain a 2x as a ceiling, which even includes the capex plans. The capex target, by the way, is 10 to 12,000 crore rupees for the next 5 years, and for Europe at 350 million pounds. Now, brokerage is very optimistic on all the plans announced. JP Morgan has maintained an overweight with the target at 1,610. Citi as well has maintained a buy stance.